The nearly everything bubble that we've been experiencing over the last decade has undoubtedly been fueled by extraordinary levels of money printing by the world's central banks. And this may have created a false sense of security for savers and investors. The resilience of asset markets in the face of a global pandemic is probably the most obvious proof of this. But can it continue? Or are we at near a financial tipping point? If you were to build a portfolio to protect and grow your finances over the next 10 years, what would be the major trends that you'd have to be aware of that could bite you hard if you weren't proactively managing your portfolio? That's what I'm discussing in this episode of the Goldonomics podcast with CEO of GoldCore, Stephen Flood, and Mark O'Byrne of Health Wealth Gold. Enjoy. So, gents, building the perfect portfolio for the next 10 years. Is it possible to build a perfect portfolio for the next 10 years, Steve?
With a time machine, absolutely. Yeah, you can look back in retrospect and see exactly what would have worked. I mean, what a world we live in. There's so much change. It's, I think if you don't feel humble after the last 10, 20 years, you never will. There's huge megatrends happening. I think when you're looking at a perfect portfolio, it starts with the self, what's right for you, and what are your outlooks. I think there are some kind of global sides that you need to always look up and do the homework, and that is like looking at fees, making sure you're getting good value for money, and looking at the totality of what you're getting for your investment. Then you have to look at the taxes and make sure that you're not offside and you're doing it correctly. And you have to look at the life cycle, where you are, where you're going to be, and when you're going to take the rewards of that portfolio planning. I always think that one of the most important things is to, and start something really small, but when you get paid or you have that income coming in, that you siphon it off into some other, or divert it into some other receptacle for investments, and you start building your assets over time. And that's a really good habit to start with. And your children should start with that, with their pocket money and all the way up. And everybody should be saving for the future. But the perfect portfolio is there. It's a moving feast, but you have to work towards it.
Yeah, now you touched on something there, which is kind of saying what are the megatrends currently? I mean, if we're looking at building a portfolio, it's a portfolio that's going to appreciate, benefit, protect you in the world that we're going to be living in for the next 10 years. So we really have to have a feeling about what type of world we think that's going to be. So what are the trends that are starting now that are set to continue? I did a video there recently on inflation and how inflation is going to impact us all individually. And how it is starting to raise its head. And we've seen now inflation figures out of the US. And as I said, when things that happen in the US, when the US sneezes, the rest of the world catches cold. So we've seen some inflation figures in the US, and they're starting to tick up. So we're starting to see inflation coming through. And we've said before that we think that inflation, and Mark in particular, you've talked about hyperinflation and the chances of hyperinflation. So inflation and hyperinflation is potentially a mega trend for the next 10 years. Mark, what else do you think that we really want to be looking at?
I think from a macroeconomic and even a monetary perspective, that is the key thing to be looking at and figuring out, I suppose, what form of inflation we have. We've had disinflation for years. We're going to have inflation. The question is it inflation of relatively benign 4, 5, 6, 7, 8%? Do we get higher inflation? Do we get stagflation, which is contracting economic growth, and high inflation? Or do we get the worst case scenario of hyperinflation? So that is one of the I suppose the primary risks to all investors and indeed savers, and therefore there's no perfect portfolio, particularly over the long term. And in the world of today, as Stephen was alluding to, it's so uncertain that you really need to be thinking, I think, more in terms of 2-3 year outlooks, and designing a portfolio for 2 or 3 years and then rebalancing rather than taking that longer term view. So what are the other trends? Well, I think the biggest one is the debt, and it's obviously something we've spoken about for a long number of years, and this global debt bubble and how it resolves itself. And until it resolves itself, I think the world will continue to be a very uncertain and unstable place, just given the scale of that debt, and ultimately it cannot ever be repaid, as we know. They're again kicking the can down the road. I think Christine Lagarde today reaffirmed that the ECB is doing 1.85 trillion. Now, it's important that people again realize the trillion it's one with 12 zeros. I'm not going to count out the 12 zeros again. It's one with 12 zeros. It's a very, very big number. It's a million billion. So it's huge, and that's just the ECB. Obviously, all the central banks are doing this. They've in effect bailed out. The entire economy has been bailed out, and they're doing helicopter money in effect. So all the currencies are going to be massively debased, and we're going to see massive inflation. And that's why you need to be now more than ever. The perfect portfolio of old was the balanced portfolio, or it was considered the perfect portfolio, by the mainstream, and financial advisors would say you put 60% into your equities and 40% into your bonds. But I think most of us realize that sort of portfolio will not do very well at all in the coming years.
So Steve, we've got inflation, and we've looked at, and we're talking about debt as well as a megatrend. What other megatrends have we got?
Well, I mean, the one major megatrend that sets this era aside, apart from any other in human history, is technology. And we hear about technology all the time, but it's really become one and part of our entire social construct. There's so many facets to it, but essentially what's happening is our technology is now leading almost every economic expression that there is. Every business, every industry, every mode of communication is being formed by technology, and it's changing everything. So the speed of ideas, the information that we get is changing. I actually think the flip side of technology and all the benefits it brings is distraction, and the amount of choice we have, and the lack of how the amount of distraction that's out there, how that's affecting our children and ourselves in our day-to-day lives. But really, I suppose technology is leading, the economic activity is following, and then that's informing how our borders and the old geopolitical lines and constructs of how we organize our societies is now shifting as well. So, I mean, a great example is the Brexit debacle, where you have people who live on one side of a border, going to work across the border, and shopping, and then picking up their kids back where they live, and all these things are now changing. And technology allows us to move across borders, and companies are set up now with people, thousands of miles away, but working in close proximity, intellectually and emotionally, but physically apart. So it's everything is changing through technology. It's happened so quickly. I mean, quickly in terms of the last 10 to 20 years, arguably in the last 5 years, even more so. So I think that's something to be considered when you're building a portfolio. What does that mean? What risks does it bring about? What opportunities does it bring about? What's your position on it? And there's a whole topic there.
So Mark, we've got inflation, we've got debt, we've got technology. What else we got?
Geopolitics is a big one that we've looked at over the years, and I suppose we've had the American hegemony in effect. Everyone after the Cold War, everyone accepted America was the superpower, at the end of the Soviet Union. But in recent years, obviously, we see the rise of China, the reemergence of Russia as quite a powerful nation as well, and you see very, very significant tensions we saw throughout the Trump presidency. We're seeing it now again in the Biden presidency, in terms of Biden demonizing Putin and Putin coming back and saying quite threatening things. So there's sort of quite threatening and aggressive language being used on both sides. And the Chinese are making very powerful sounds there as well, as he made a very strong statement there just in recent days, basically saying that, don't mess with us, so to speak. I'm simplifying, but there are real tensions there, and I think these tensions are likely to become even more heightened in the coming months. You can see little flashpoints in the Ukraine, obviously. You can see in Belarus, you see flashpoints in the Middle East, and obviously down in the South China Sea and Taiwan as well. And then that could rear its head in terms of the trade wars that we saw in recent years, and then back to the currency wars as well. And I think the Chinese obviously have been buying a huge amount of gold reserves over the years in order to position their currency, the Chinese yuan, as the reserve currency to rival the dollar. So
that's kind of a sub. That's kind of a sub theme, or a very important theme rather. And we actually just released a blog post on that today.
Oh, very good. I haven't got a chance to look at that yet.
About the rise in gold purchases by the Chinese. But as another major theme is that idea of the U.S. hegemony, but and in that the dollar's role as the reserve currency of the world, and how that may be changing or unfolding as we go forward over the next couple of years.
Exactly.
Do you agree with that?
As we move to a multipolar world,
yeah. Right. Okay. Well, let's talk about inflation. So, if inflation is a mega theme, inflation, hyperinflation, deflation, if that is a mega theme, how's that going to impact our portfolio? You start, Steve. You've talked before about the impact of inflation on cash or cash reserves. Do you want to talk to that for a second?
Yeah, I mean, there's two sides to the inflation concept. Obviously it means that the prices of everyday goods start to rise, and rise faster than it would ordinarily be expected. And what that really means in reality, to take it home, is that your cash in the bank will lose buying power over time, and usually quite quickly. So there's if you look at an whatever the official inflation rate is, you could safely double it in terms of reality. They tend to underreport inflation for political reasons, using hedonic adjustments and different things. There's lots of different oddities around how inflation is calculated. But typically, if you were to look at inflation, look at the price of health insurance. That's a really good proxy for the real on the ground rate. And so the worst place to be is what people, and it's a misperception out there. People think the safe place to be is in cash in your bank account. And we have lots of clients who have significant sums sitting in banks, and they think
cash is king is the old adage, isn't it?
Yeah. And cash is king if you're in an active market and you're looking to pick up a bargain and you can move quickly. That's really what that adage is about, but not cash is king over the long term, unless you're getting an interest rate that's fairly paid. But our entire interest rate marketplace has been completely manipulated by the powers that be. So if you're looking to get a return on your cash, you're going to get, if you're lucky, a neutral rate, if not negative, and it's becoming more negative all the time now. And then if you're looking to borrow money, they'll charge you 6-7 multiples times that actual interest rate to lend to you. So there's a huge kind of, it's very, very corrupt what's happening. So do not be in cash. Look for alternatives that are safe and that you actually maintain the buying power of your safe haven asset.
Yeah, so negative interest rates, what we're effectively saying there is people are getting charged negative interest rates, so they're putting money on deposit, and at the maturity of that deposit, they're getting less money back.
Yeah, which is incredible. I mean, it's real topsy-turvy stuff. It makes absolutely no sense that you would actually have risk. And
you do have risk. Ultimately, you have risk. Now, there's a degree of protection afforded by various different guarantees, but you still have risk to that, to the institution that you're placing your money with. And you're getting less money back at the maturity of your deposit if you've got negative interest rates. And then on top of that, if you've got inflation, which is running at a rate higher than what official inflation is, that money that you're getting back, which is already less, is buying you even less goods.
Yeah, and your money's not working either, so it's actually just sitting there. It's
opportunity cost.
It's an opportunity cost. It really is. It is the worst place to be. So people need to really
tax on deposits in many nations internationally as well.
Yeah, but does that mean if you have a negative interest rate, they'll actually give you a credit back and you eventually get some money back? You know,
of course they will.
So.
Yeah.
I don't think so. Yeah, they should be giving my dirt tax that I paid for. That's the Irish term for tax on interest rates. Our interest is dirt, and they should be giving that back from years before, where they charged it on my account. So yeah, I don't think they'll be doing that anytime soon. But it is. I mean, really, what's happened here is that we live in a world where the technocrats have taken control and are making up their own rules, and they've created this kind of apocalyptic financial system that is fundamentally flawed and has been abused. And they're now they're doubling down on their previous policies, and they're hoping that they can buy time, that the people won't catch on. And that they can see their way through. People will kind of forget, and they really are making it up as they go along. And you see this in some of the press releases that they come out with, the language that they use. And there's kind of an unholy alliance between the financial media and who observe and report on these commentaries from past commentaries on these officials and technocrats, and they want to believe that what's being said is true, and there's been said, they hope that the guys who are reporting it will believe it too. And in reality, the emperor is butt naked. There is almost no fundamental logic to what is happening. And you can see it because they started off in exceptional circumstances by passing legislation to bail out the banks because they were systemically important. And now you have a situation where almost all banks are controlled or are beholden to the officials who print money, who buy the bonds, who then they sell those bonds and they make more money, and they have these interests where they pay negative rates to the depositor and they charge outrageous rates on the lender, and they're building up their balance sheets again, enriching themselves at the cost of the public. And so it's a shocking state of affairs. It will come undone, and I don't know when that's going to happen, but I do think what you're seeing is asset price inflation everywhere. The stock market is going in lockstep with the central bank balance sheets, which has grown incredibly. I mean, I think 20% or 30% of all dollars in existence were printed in the last year. This is a hockey stick. This is going up at an incredible rate.
And exponential at this stage. Yeah.
Exponential, and this is coming home to roost. So that's the background for inflation and hyperinflation.
I mean, that's it. That's it in a nutshell, effectively. I mean, inflation has come from the inflation that we're seeing now is the result of massive money printing that we're seeing by central banks, and we're seeing that as their attempt to stimulate in the last year to stimulate the economy in the face of the global pandemic.
Yeah, and I don't mind having inflation is fine as long as you're paying me more money. Then the inflation rate is rising. Then the real effect of it is neutral. But in reality, that doesn't happen. One lags the other. So then you have an impoverishment comes about. And then when people catch on, they go, yeah, I got paid X, but my cost of living has gone up by Y. So I'm not going to go on that holiday. I'm not going to buy that car. I'm going to go to ground. And you have this safe, this kind of survival mechanism kicks in en masse across the population, and they stop spending. And then people go, oh crap, I can't build those cars, and I can't, open that hotel and whatnot. So it's very, very dangerous. And I don't believe the rhetoric that they came out recently from the Fed was, yeah, we're okay. After telling us for years that they didn't want any inflation because after the 70s they realized inflation was a nightmare. Once it gets out, it's like a Pandora's box. Once it gets out, you cannot stop it. And they said you target at 2% and we won't let it go over 2%, and that's okay because it'll burn off the debt that we have. And now they're saying, well, you know what, we're okay with a little bit more inflation. So over 2% is okay. It's just nonsense. They are totally out of their depth.
Mark, I'll put something to you now. As Steve's put it there, the Fed historically targeting 2% as an inflation rate. They have been printing astronomical amounts. They're now letting their target rate go, and they're moving to this kind of averaging system, and we're starting to see that inflation kick in. Now, back to what we said, the official inflation rate doesn't necessarily represent what the actual inflation rate is at the pump, at the checkout, wherever it is that you're spending your dollars. But are these two things, and if we bring in the idea of debt and inflation, these two things they're one and the same effectively. But if the Fed is, or if money printing and central banks are continuing to print money. Don't they need inflation as a way to effectively lessen that debt that they have created?
Exactly, yeah, and that's exactly what they're doing. It looks like their option is now to wipe out the liabilities, because the US alone, the nominal debt now is, it's hard to keep up with it, but I think we're up at about 27, 28 trillion. I haven't looked at the national debt clock in the last month or two, but it's up there anyway. It's headed towards 30 trillion very, very quick with Biden's new stimulus. I love that word stimulus. It's one of the most abused words in history. And so it's that's 30 trillion, but they've another 100 trillion, or between 100 trillion and 200 trillion. This is just the US alone, and all the European nations, all the West, the UK, all the Western nations have massive pension liabilities and all these unfunded liabilities. And that's in the US alone, that's between 100 trillion and 200 trillion. So that's Social Security, Medicare, and Medicaid. So there's no way they can pay that. So they are just going to electronically create the trillions and trillions of dollars that are used, and they will devalue their way out of it, in effect, and Stephen made the point, that the people, they basically, people, they look at their salary and they go, oh, wow, I've got this amount of money, this is great. But meanwhile, the cost of living's gone up because their rent, their health insurance, all these other costs of living's gone up. And it's not just the people on the salaries, the people who get hit the most are the people in the fixed incomes. So the people on the COVID dole and the pensioners and these people, that's when because it's food and energy. What's happened then, this is an important distinction as well, and you've both made some great points. One thing that's important to realize, what's happened with inflation in the last, say, since 2009, is the inflation went into the asset markets. So it went into the stock market and then to the bond market primarily, and it reinflated, in effect, bubbles, particularly in the stock market, and it put the stocks at all-time record high prices, and it put yields negative in effect. And we've got roughly 15 trillion of negative yielding bonds, which shows the risk both in cash and in bonds. And so in that scenario, it's 15 trillion negative yielding. Your deposit or negative yielding. I mean, all roads are pointing to gold, So the other thing is the inflation went into the asset markets, but it hasn't really gone into goods and services just yet. But it's beginning to, Dave, and I think you did a good video the other day on that. So we're beginning to see that, and I think we're going to see much more of it. And they're going to have to admit that inflation is actually higher than it is. I think people are going to become more aware of it. There's going to be more of a spotlight on it. We've talked about it for years because John Williams uses the metrics that they used to measure inflation in, say, 1985, 1990, 1995. Every year, over the years, they've gradually changed, as Steve mentioned the word, the hedonic adjustments. They've changed how they calculate inflation. But if you calculate inflation like they did, say, in 1986, I think in the mid-80s, you will get a truer rate of real inflation that people are actually experiencing out there in terms of the value of goods and services. And that would be closer to 8 or 9 or 10% even in the last few years. So we're actually going into an inflationary phase from quite a high point, shall we say. We're not down at the 1 or 2% inflation that the governments would have us believe, so that's an important thing to be aware of.
Indeed, and we are seeing a fair degree of inflation in food and energy coming through. That does tend to hit those that have less disposable income, the lower income classes, an awful lot harder than those with a higher disposable income, which will continue to increase the gap between the haves and the have-nots. So there's a societal impact on this, not just not just a financial, but the financial impact is going to create a societal impact as well.
And this comes at a time when the baby boomers are beginning to retire in the US. So the demographics thing is the other big trend that we've spoken about many times over the years. So the baby boomers, not just the baby boomers in the US, but there is an older cohort of people who are beginning to retire in their 70s now in the Western world in particular. And just today, the national transport company in Ireland, which is called CIE, is warning about the public pension in that transport. It's the biggest, it's the national transport organization responsible for national coach services, bus services, train services. So they're warning about their pensions. So we're getting to that. We've been talking about these pensions time bombs for a year. So all these things are connected, and we're going to see the rubber's going to hit the road, as they say. It's the kicking the can down the road only lasts for so long. We're getting close to the end of that road. We're going to see the ramification of this in the next few months.
There's an incredible pattern that's happening here. So they're printing all this money and they're buying all these bonds, and the yields in the bonds are dropping. Okay, So you're finding that these bonds are producing less and less returns. So these pension funds, like in the bus companies, are suddenly underwater. They're not making any money, and then a lot of that money is pushing up the prices of stocks as well. And so all these kind of unfunded liabilities on these pensions that are underwater are now going into more and more risky assets and bidding those up. And you're seeing like, hedge funds and leverage, and it's feeding off itself. And the entire system has become, lopsided and dangerously so, like a boat. And the thing is, and as in physics, sometimes you get to this kind of this moment, or this threshold, and suddenly the entire boat just flips, and you can't stop it. And they're dicing with death, so financial death here, by changing the actual fundamental plumbing of our monetary system and our assets that are priced in that money. And it's, I think you're going to see it. There's people looking for pay rises, and you're going to see union problems. You're going to see impoverishment and changes in consumer behavior. So it's a very, very dangerous world. And the only answer to inflation is increase interest rates to take the steam out of that kind of speculative fever. And
or write off debt, some form of debt.
Write off debt. Well, write off debt
help as well. Yeah.
You write off debt, you're writing off assets. So you're helping one part of the balance sheet, and you're hurting the other.
But you would be helping more the productive element of the economy, and the citizens and the small businesses and the asset holders who are already fairly wealthy in the banks and institutions would suffer more in that scenario. There are risks on both sides, but the net benefit for society. That's why there have been debt jubilees throughout history, because
but it's like they'll reduce your mortgage one day, and then your bank collapses the next, and your savings are gone. So it will come. You're not going to isolate one group of society from another. This it has a total effect across, and it will affect everybody.
Steve, just want to pick up on there, because you're talking about this basically it's like a financial tipping point is what you're talking about. Now, we've been doing this podcast for the last 3 years, and I was looking back there recently, and we have an episode that's entitled something like "Beware the impending global debt bubble collapse," or something to that.
I just like to say we actually are happy people. We're not like doom and gloomers.
You haven't heard the rest. You haven't heard the rest of what I'm going to say, because the next one was basically a year later, was with respect to stock markets. And talking about stock markets, how they're massively overvalued. And at that stage, I think the Dow was probably about 20,000 or something like that. Now, rather than being kind of doomsayers, this is this idea. We've been looking at this getting progressively worse and worse and worse over the last couple of years. But it's still the stock markets have still continued in the one direction. Bond markets, bond yields have been lower, right? We haven't seen a crash; they're slightly higher now, but in the greater scheme of things, historically, relative to historical yields, they're still very low. Can this continue for longer before that it actually gets to that tipping point? What's to suggest that we're at that tipping point or close to that tipping point at the moment?
It's a huge question. I will put my hand up and say, I think I'd stand by everything we've said all along. We're looking at history, economic history. We're speaking from experience. We are at the kind of, at GoldCore here, we have thousands of clients all over the world who feed into us all the time. And so we take that information and knowledge that we gratefully have access to, and we share it with the people on our channel here. It's very hard to say. They can keep this show on the road for as long as people believe in the system. And I think going back to what I said earlier, with technology and all the options that we have, one of the negatives is the distraction that we have. We are very, very distracted people. I don't think, we don't have gray time where we can sit on the garden wall and chat to our neighbor and just randomly talk about various different things and observe the world, within small groups. We are connected to thousands of people. If you ever think about the amount of messages you get all the time, you're constantly having your attention divided and siphoned off. So in a way, that moment where people realize that the emperor is naked and that they need to move and take action, it could be a ways off. And when people are being enriched by higher asset prices and their house prices going up and their stock portfolios going up and things like that are happening, maybe they will say, it's a convenient problem to have for me and where I am in life. And a lot of people, some levels of society are doing really, really well. Like the rich are getting much richer. The upper class are too. The poor, as long as they have social supports, which is they are getting social supports, they'll happily let it go too. So I'd say the tipping point is actually probably something that Mark said in terms of the geopolitical risk, because there is a misalignment politically. There's no hegemony anymore. I think that the US has lost its hegemony, has done many, many years ago. And China and a group of other countries are now taking their position in the world, and they're going to assert their dominance, or where they can, in their own spheres of influence. And I do think that's going to happen probably over the next few years. So you might have two dual systems, and one will survive, and the other will have to explain itself until it's taken over. So yeah, I think the chips are down, and I think the Americans, though, have actually woken up to this recently. I think they're aware that they have kind of been asleep in many respects.
I wanted to actually just kind of pick up on that, because you said when you talked about the tipping point, and saying that one of the things is actually an increase in awareness of what is actually going on. And I think you're about to say that that's happening in America. I think that there's actually a bit of a trend of that happening globally with respect to this idea of money printing. And I suppose as inflation actually starts to kick in, and you talked about health insurance there, and I recently renewed health insurance, and it was up significantly, much more than 10% even. Yeah. So people are going to, when they start to feel this in the pocket, I think is that when they're going to start to ask the questions and start to become more aware of this.
Yeah, I think so. And I think actually some of the early movement towards crypto and the questions it raised about the monetary system and is born of that frustration too. Now, I think there's a whole load of money in there. It's a different story, but it's very much speculative at the moment. But it's happening. You're also seeing it with central banks acquiring gold and having their gold repatriated. So I think the Bretton Woods agreement is being kind of, the arrangement there and King Dollar and all of this is being questioned now, and people are looking nationally. I think also, recent political developments in the States has shown that, that global partnership model is no longer reliable. And people and countries and nation states have to look out for their own increasingly. So that's going to be reflected in spending and money and asset allocations as well.
So we looked at inflation and debt, and they're obviously intertwined. One is causing the other. But when we talk about debt, we're effectively talking about the bond market, and bond markets have seen a bit of a sell-off over the last 6 months to a year from their heights. But they're still, as you said, relatively historically, yields are still relatively low. In order for you to get a decent return on any investment in bonds, they need to rally again from here. And even if they do that, you're still, like, you've got a 10-year in the US at what? It's about 1.6% or something like that. That's a 1.6% return. It's a very poor return. You might get a little bit of a capital appreciation if it rallies, but who's going to be buying bonds going forward?
Well, I think these
US Treasury.
Yeah, the ECB bought every single bond issued by governments this year. I mean, you can't make this up. It's shocking. Like, this is not real.
No, exactly. But that perception, it's all about perception. And Steve was right in saying that and there is amongst a small segment of the population an awareness that this is completely unsustainable and it's a Ponzi and it's a house of cards and all the things we've talked about over the years. But the majority population, they're spellbound by watching BBC and RTE, and you would not get a sense of this if you watch the mainstream media. You would not get a sense of these real risks, because all they talk about is the risks from COVID, and they ignore all these risks, and they also ignore the risks of the lockdowns and the amount of damage that the economic destruction that's been done by lockdowns, but it's funny. I think that the pandemic and the lockdowns, it's almost like we went into, it gave them carte blanche to do whatever the hell they wanted, because they had emergency powers. In effect, it was like a wartime scenario. So they had emergency powers. So the journalists, the media, they started even asking even less questions, and there's no critical thinking, there's no debate, there's no plurality of opinion about any of these issues anymore. It's just like the central banks are the experts. We just have to trust them. They've got our back. They know what they're doing, That's a very, very dangerous scenario, So nobody knows when the tipping point will come, but come it will. We all know that, and it could be a geopolitical flashpoint. Is the tipping point,
Yeah.
But the best thing is not to try pinpoint or predict. Nobody has a crystal ball. It's just to get the rough. If you get a good sense, you roughly know, right, I know the risk here. Now, what do I do? How do I prepare? And if you do that, then it doesn't really matter whether it happens in 6 months or 6 years, or 10 years with our permanent portfolio.
Yeah, I think if I was to take a guess, the tipping point is going to be a Chinese government issued bond, like a euro bond or whatever it is, but it's going to be Chinese yuan, and it will pay a rate. It'll be backed by maybe bullion, incredible reserves that they've picked up over there. It'll be secured on their tax base, and it will, for the first time, vie for the dollar, the treasury market internationally, and I think that'll come in the next. It could be months from now, and when that happens, and if the PR campaign is done properly, it will attract significant flows. At first, a little, and then over months, the flows will start, and you will find that the Chinese govie market will be the biggest in the world, and that will be representative of its of China's influence internationally. And and I think I think it's a matter of time.
We are at a kind of an inflection point there with China at the moment. As per the article today, Steve. China's growing at a greater rate now than it has in the last 10 years. It's no longer buying as many treasuries. Its holding of treasuries is starting to fall. Its holdings of gold are continuing to increase. So you read between the lines here. They're divesting themselves of US dollars and they're buying up hard physical assets. There's an end game here.
There is, yeah. And another potential inflection point is hashtag silver squeeze, which could indeed lead to hashtag gold squeeze. So, there's a lot of talk. That recent silver squeeze didn't work, obviously, but it's now spread from, it started out on the GameStop guys and these people. But now I think there's some big money internationally looking at it, is my sense, including Sprott, who's one of the billionaires in Canada. And he's endorsed another silver squeeze campaign going into May 1st, which is coming up. So if you see a COMEX default and questions, then will the focus will move from silver to gold, and what are the risks there? And if the gold price starts moving up very, very significantly, then things could feed on themselves very, very quickly. So that's another potential inflection point. And
it's a building of this awareness. It's
exactly. Alternate. It's the alternate.
Yeah. It's the man in the street is starting to become aware of what's going on with the currency in their pocket.
Exactly. The things we've spoken about for years, and Stephen mentioned the cryptocurrencies, they're beginning to, I see it in the mainstream papers here, and it's amazing how favorably they talk about Bitcoin, some of these journalists, and they never once had anything favorable to say about gold, despite the same fundamental reasons that they critique the dollar and the euro, and they justify it. This is why people should consider on Bitcoin. But these same journalists never said the same thing about gold or silver over the years. It's interesting. But they're very favorably disposed towards Bitcoin. And now we've been talking about the cashless society for a long number of years as well. We did quite a bit of research on that. And now that's very much mainstream. It's on the agenda in quite a significant way,
And it's fairly, again, back to China. To China, it's fairly much there in China. It's practically impossible to spend paper money in China. Everything's digital. Everything is, there's two different accounts that everybody has on their phone. And, even you go down to the market to buy your groceries, and there's two prices there for the two different methods of payment, and they're both digital, and it's practically impossible
at least they can go to their grocery. Oh, sorry, we can go to a grocery right now. Sorry, yeah. Soon they'll make us click and collect, so there'll be even more data there. You can track and trace. You can make sure you collect all the taxes, all the rest, and then you do the social credit score based on. It's very, very, very dangerous. And in Sweden, they've moved away from the purely cashless model. They said, no, we want to have a certain amount of cash because we believe in being diversified and not having all our eggs in that digital basket, So there is a risk there that needs to be discussed, and it's not being discussed.
It's a huge topic. I actually think probably it's the top one or two reasons to own gold or for to see the gold appreciate is the actual digital monetary system, because if you want cash and you can't have cash, actual paper money, the next best thing is physical gold in your possession or stored security for you as a form of money that is going to survive whatever is to come, in physical form. And I also think with digital money, I think the idea of anonymity will be gone forever. In order to participate in society and to transact, you're going to have to be known. And there's cash gives you anonymity, which gives a degree of strength in the society and resilience and independence for the person. And I think you're going to lose that with digital currencies completely. They won't allow anonymity at all. I can't see it happening.
We've talked about cash and the dangers in cash in the inflationary environment, and we've talked about bonds as an asset class and their lack of yield unless you want to go east and start investing in Chinese bonds where you might get a yield. And so naturally now, as we start to talk about digital currency, Bitcoin has been on a mega run for the last while, and and since December it's gone from whatever it's up by a factor of 3 or 4. So what's the future? I know this is a very big question with a potentially entire episode dedicated to the answer, but in terms of building a portfolio, does Bitcoin have a role in a portfolio going forward? Now, I know even by asking that question, I'm going to get loads of people in the comments going, you don't understand Bitcoin. Of course it does. But central banks hate Bitcoin, right?
They hate competition.
Banks hate Bitcoin. They are very keen to roll out their own central banks. They're called the CBDC, the central bank digital coin. It's obvious that China is working on one at the moment. India, they banning crypto transactions. Is the writing not? If you read between the lines, is there not a way for them to, is there not a chance of them just legislating against Bitcoin when the time comes? They're increasing the popularity. And we had a guest on, David Brady, on a while ago. He said, if you read between the lines, what they're doing is, central banks are happy for Bitcoin at the moment to continue to appreciate, garner attention, and get people used to the idea of transacting with digital currency.
And take demand from gold and silver as well.
Yeah. But that there will be a time comes at some stage in the future where they just legislate against it, and then and all of a sudden you have your Fed coin, and here's the Fed coin that is eminently traceable, trackable, and puts Bitcoin in the bin.
Yeah, there's a good chance of it, and that that you mentioned there some of the things that are happening in that space. There was another development there. I think it's just today actually that the big Turkish crypto exchange, so the Turkish lira, has come under huge pressure, and it's been massively devalued again. And the Turks, there's been big moves and big imports of gold into Turkey. A lot of gold buying in Turkey in recent years when they've had a few different financial crises and indeed little currency crises. But there, in recent weeks, I think a lot of money has been going into Bitcoin and into cryptocurrencies in Turkey. And now the crypto exchange, I think it was raided, and I think the founder of this exchange has gone missing. And so it's going to be interesting whether those people can actually access their assets and can actually, liquidate for cash. So
if you're a government, sorry to interrupt, Mark, but if you're a government, all power comes from your ability to tax and manage the monetary system. The Rothschilds, he wasn't wrong when he said, give me control of a nation's money, and I will control the world. I mean, it's the truth, and why on earth would you, these guys, these crypto supporters, they stand there and they're like two fingers to the monetary system, and they believe that they're going to replace the monetary system. No, you're not unless you have political power, and they don't, and they're in the minority, and most people are not, going to jump up on the barricades and give their lives for something like that. So I think you're absolutely right, Dave, when you say that this is actually a conditioning. There's an upside for the banks because it's conditioning them into this idea, but people don't realize that with this new crypto backed currencies, huge benefits, but there's also a huge cost, and that's in privacy as well. So if they can create a cryptocurrency that allows some sort of cash aspect to it, which is an anonymity for transactions under 1,000 that you don't actually have to give ID and who you are, as long as it's real and blessed, maybe that would be a perfect substitute for this. But yeah, I think they'll absolutely kill Bitcoin. Sorry, I think there's probably a 40, 30, if I was to give odds, maybe 40 to 50% chance that blockchain or Bitcoin will be banned, but not other productive assets. I think certain tokens that are contractual based and have actually a utility tokens, I think they have a very important role to play in our society too, and they won't be banned. But anything that competes with the currency, if they identify Bitcoin, nailed. Ethereum, maybe not, because it actually there is a utility aspect to it. So so maybe that has a different path. I don't know. XRP maybe will survive.
So if we're looking at crypto, if we looked at cryptocurrencies, and if you roll back only a couple of years ago, if somebody was to suggest that cryptocurrencies were an asset class, you'd be laughed at. But they have to be taken seriously given what's happened over the last couple of years. We're seeing, as a result of money printing and monetary inflation, we're seeing a lot of money flowing into them, and that's why we're getting this rally. Maybe it's this awareness building amongst a wider population as to the damaging effects of the incredible amounts of money printing that we've seen.
And the scale of monetary risk, absolutely, yeah. Some people, I did say a few years ago, it's not an asset class, but put a small amount into Bitcoin because it should do very well in terms of price. But it's a speculation. It's not an asset class.
I wish I'd listened to you, Mark.
Yeah, you should have, Dave. Yeah. But I did say less than 1% of a portfolio, because it is that high risk, and it is binary. As we all know, it goes much higher, or it goes to zero because it gets banned. And I hear everything Steve's saying. I agree in part, but I'm not sure the governments are quite as powerful as he thinks they are. Ultimately, the people have the power, and if the people decide we've had enough of your dollar, your fiat dollars, we've had enough of your Fed. We don't trust your Fed coin, and if there's mass adoption of Bitcoin, then it could de facto they may have to accept it. Potentially, but because they'd have to go down a very highly repressive into a form of a police state if there was mass adoption by the public,
and that's people why stop eating, if they get hungry, that might happen. But if they're not hungry, they're never going to overthrow the government per se. And just on that, on the 1% of your assets in Bitcoin, just on that, I do think you should definitely put a portion of money in Bitcoin, whatever it is, because if you don't and it goes up to $1 million, you're going to do your head in. You're going to be so upset. So just put something in there so you can participate emotionally in this thing. so they could do it.
Even if that's 100 euros, yeah.
100, yeah. I put in a few hundred euros into Bitcoin recently.
I put it into Ethereum as well as
I put some money into Bitcoin recently, and it went up 6-fold. I was like, what the? And then I'm trying to teach my children about investing in stocks. And one of them, he sold a stock that he bought. I think it was Sony. And he put his money into Ethereum, and it's gone up 30%. And so I'm wondering what sort of lesson he's learning right now. And so buy some Bitcoin or crypto or whatever the hell it is. By the way, anyone watching this, we're going to be auctioning off the NFT, the non-fungible token rights to this video for $65 million. You can own this video today and own the rights to it.
That is cheap.
Cheap as.
So crypto has a role in a portfolio going forward. So if we look at our portfolio going forward, we're saying you want to be thin on cash. Bonds, it's difficult to make much of an argument for them. To protect you from what's coming. Cryptocurrency has a role, but has a risk. Would you agree with that?
Small role, yeah. But it is still quite speculative. Yeah.
Equities. I want to talk to equities now, particularly in this environment. Money printing has had undue influence on equities over the last good couple of years, and we're seeing the Dow now at whatever 34. Now again, we're just using the Dow as a benchmark. Similar is happening across the world in many stock markets. In a situation where you got massive money printing and hyperinflation, equities still have a role in a portfolio. And again, it's back to the video we were talking about on inflation there from last week. I think it was 2018, 2019. The best performing stock market in the world was Venezuela, with an annual return of 200,000%. That down to inflation or hyperinflation.
Currency had fallen 99%.
Yeah. So it's a case of, depending upon how much you buy into this hyperinflation argument, you want to be out of cash, because the value of your cash will just disappear up its own wazoo. We've got a negative interest rate environment. We've got hyperinflation, so the value of that currency just totally disappears. You are better off in that instance holding stocks, because they are going to offset some of that inflation.
Anywhere for cash.
Yeah, but that's you very much focused on hyperinflation there. There is a scenario of stagflation, and in that stagflation scenario of contracting economic growth and very high inflation, then stocks might go sideways as it did in the 1970s, So, but I suppose in terms of looking at the portfolio, traditionally the balanced portfolio was 60% equities, 60% stocks, and 40% bonds. And I think that sort of portfolio for the birds now. Anyone who would suggest that in the current climate, putting 60% in equities is a bit mad. Your man. Sorry, I shouldn't call him your man. One of the leading investment gurus of the 70s and 80s, Harry Brown was his name, and he had his sort of all-weather portfolio, and he was 25% gold, 25% cash, 25% bonds, and 25% stocks. So yeah, stocks, bonds, 25%, gold, cash, 25%, and they've crunched the numbers of that portfolio over the years, and it's done really, really well. 7-8%. Hasn't done as well as gold by itself, because gold by itself has done about 9.3% per annum in dollar terms, and it's done even more in other currencies, obviously. So, and then Stephen mentioned Ray Dalio before, who's quite interesting. His portfolio, I was just checking out before he came on. He's actually 55% in bonds, US bonds, which is very, very high risk. He's 30% in US stocks, US large cap stocks, then 7.5% in commodities and 7.5% in gold. So again, I think he's over allocating to equities and bonds, and I think
the bonds are inflation protected. I think is a large portion of our tips.
Some of them are tips, yeah, but I think only about half of them, But anyway, bottom line is
official inflation protected though.
Stocks, yeah, exactly, and according to the official government inflation statistics, which, as we know, are adjusted quite significantly. So anyway, bottom line with stocks is I don't think that the fire and forget putting a large chunk of your portfolio into stocks and putting it into an index and buying, global capitalism and buying the MSCI World Index will be the way to go. I think you'll have to be a bit more in inflation. There's actually certain stocks do really well and there's certain stocks do very badly. So you need to look in terms of inflation. Agriculture will do well, you would think. Energy, natural resources, that there are the sectors that I think you'll be, because these are the industries that will have purchasing power,
And if we tie that all back, we are seeing inflation in those industries, or we're seeing inflation in the products of those industries. The food and energy industries,
supply chain, yeah.
So if we're going to see more inflation, it is logical then that those producers are also going to see inflation in their value.
Yeah, they should do well, you would think. Yeah. But it becomes more sector specific and maybe even stock specific, but it's
so to be a bit more active.
Very high risk thing.
We have to be a bit more active going forward. And this idea that has been very popular over the last couple of years, and Steve, you've talked about this in the past as well, this passive index investing, and how maybe the time has, maybe the sun is setting on that, or does it still have a role going forward?
I think it has a role for some investors because investing is very emotional for a lot of people, and they get attached to what their targets are, what they're looking to, what they're buying and selling. Most people will buy at the wrong time, sell at the wrong time, incur higher fees along the way, and may not invest with consideration to the tax consequences. So, the whole fire and forget. There's a lot of I think, there's a good case for it for the average investor. But I do think that you qualify your stock investment if you're going to buy an index, qualify it with, those fundamental components of a portfolio, such as, precious metals. And I know that sounds like we're talking our own book, but we fundamentally believe that is the bedrock that you build your portfolio on. And you look at other alternates, like I said, maybe, good quality property and things like that. So we might talk about, what constitutes that portfolio at some point in the future. But I think, in my own portfolio, I look at stocks, and I don't just use any stocks. I look at Chinese consumer indexes, Indian consumer indexes, and things like that, and technology indexes, and as well, and special opportunity stuff. So I think that they're in keeping with megatrends for the future and what's going to happen. I think they'll outperform most other things. In that outperformance, they might be insulated from some of those other bigger kind of changing of the guard in terms of geopolitics and what that means as well. So there's a number of benefits to having stocks. Stocks are very, very important. They're productive capital when operated correctly, I think you absolutely need to have stock and equity in your portfolio. Just be careful about it and make sure you get good advice. And for the record, we're not giving financial advice on this podcast.
Indeed, yeah.
Exactly. Investments can fall as well as rise, and past performance is no guarantee of future returns.
Yeah.
And that's so important, because frequently the mainstream uses the past performance of stocks and bonds to justify the coming performance, and there's absolutely no guarantees of that previous performance happening in the coming years, as is the case with gold. I mean, I said before, gold's got up 9.3% per year for the last 20 years and roughly the same returns over 50 years. There's no guarantee that's going to happen with gold in the coming years, but given what's happened throughout history, it looks most probable that will happen, and potentially gold should even outperform, given many of the risks that we've spoken about today.
Yeah, I think you mentioned the Dow Jones earlier as a proxy with caveats, Dave. I mean, the Dow Jones, I think it has one single stock, over the last 50 odd years, it gets turned over. But where champions 10 years ago aren't anywhere near it now. So there's a constant creative destruction going on in the equity markets, as it should be, to be honest. I mean, you should have creative destruction. So our champions today may not be around in 10, 20 years.
The one thing that we haven't touched on, gents, as an asset class, which is obviously really important, is property. We're seeing hotspots in property again all over the globe. We're seeing property strangely enough, during the COVID lockdown here, anyway, in Ireland, property prices have continued to rise and rise faster and faster. What do you think about property going forward in an inflationary environment, in a continuous increase in money printing, the magic money tree, more money today? What do we think is going to happen to the property market?
I think there are some that are very overvalued indeed. I mean, London being a classic example, and a few of the other big cities around the world, they look very overvalued in terms of both residential and commercial property in these cities. And you would expect a correction. I think a lot of us are surprised. I think on one of our previous videos, we were saying, given the lockdowns, the commercial side of things will be more vulnerable because, you know, the large corporates have realized they don't need half as much office space as they did before, and therefore commercial property should see a correction, but it hasn't really seen a correction. As you say, Dave, most property markets around the world have remained amazingly buoyant. I think there's an element of sort of, we're in this sort of holding pattern. It's everybody suspending big decisions, waiting to see what's going to happen. But I do think we should at least have a correction in these property markets, and potentially quite a serious correction. And then I think the inflation will kick in, and then obviously property does quite well in inflation, you know. So I think you'd be leaning more towards residential though than commercial potentially. And yeah, I mean, you have to think about the underlying currency as well, because if your property goes up 10% or 15% per annum, as it has been doing for many, many years now. You know, we've had outsized returns in many of these property markets internationally. But if your dollar falls 20, 30% a year versus, say, gold as an example, as it did 2 years ago, or sorry, last year was down 25% versus gold, then your property is actually down in real terms. So you have to think about it in real terms. You have to think about the yields. You know, it's quite an interesting and quite a complicated asset class, but I think there's definitely a place for it in a portfolio, the 20, 25%. But it looks a little bit frenzied at the moment, particularly in the US. I saw a statistic the other day. I think there's more realtors. So there's more real estate agents in America today than there are actually properties for sale. So it's crazy statistic. I had to look at that twice. It was in the Wall Street Journal, and I had to read it and say,
supply side has fallen dramatically.
That's exactly it. So there's a lot less houses on the market, and then there's a huge amount of unemployment, and desperate people are saying, well, this is a quick thing I can get into. I can get qualified relatively easily. I don't have to go to university and do 4 years and spend a huge amount of money. It's actually quite an easy thing to become a real estate agent in the US, you know. Yeah. So, but they did make the point. I think it did happen around 2007. So there's a few little parallels in terms of, you know, the 2007, 2008. I think these property markets are more vulnerable than people realize, you know, and obviously they're doing well because, you know, they flooded the system with cash. They put interest rates down to zero. It's very cheap to borrow, so that has prolonged this overvaluation, you know. But it's hard to know how sustainable it is, you know. So yeah, that would be my view in a nutshell.
Just on the property question there, Dave. I mean, like if you look, I think properties is the recipient of investment flows that have been frustrated out of the bond market, and because there's no yield, so people are looking for the search for yields, and they're doing crazy things. So they're going into property, which is the next best thing, bricks and mortar. I think it's also determined by interest rates. It's very cheap. If technically for like big funds and property companies, REITs, real estate investment trusts, to borrow money and invest in property up until the COVID crisis. So that would have driven property valuations as well. And then you look at the kind of
even throughout the COVID crisis. That's just as you're talking about that, it just reminds me of a couple of themes that are going on here in this country. I mean, we had the buy to rent phenomenon over the last couple of years, where everybody became a landlord, you know, and rented out, trying to make a buck. But now you've got this idea of build to rent, whereby we're having entire apartment blocks where they used to be bought by individuals to live in, or even as investments to rent out, but primarily to live in. Now you're getting funds coming in and buying that entire apartment block in one go with a view to renting that out. And as you say, this is money that's been diverted from the that's gone out of the bond market because they're not getting, potentially not getting returns. It's going into the REITs, and the REITs are, whether
they can borrow cheap.
They can borrow cheap, and they can buy these in one big lot. The banks love that because it's low risk. Here's it's a single loan. We don't have to do all the paperwork and all the administration on all of these. We have of all of these loans. They're very cash rich entities that are purchasing it. So it seems to suit the banks. It seems to suit the governments. Doesn't necessarily suit society, because now we have a problem where you're getting, it's extremely difficult to rent. It's squeezing the availability of properties for sale. So hence that's putting pressure on the market. So it's really changing. It looks like it could seriously change society here anyway, and how we live and how we invest in property.
Yeah, it's come full circle. Years ago, we had the Land League, where we were all renting, and we had these absent landlords in London, and they owned most of our land. I think they own most of our country. We threw them out basically, over time, and we got control again. Looks like we've gone back again, and we've given it to the financiers, and they're
the new absentee landlords.
Yeah, they are really, and it's a function again of interest rates, because the punter on the street borrows takes a mortgage out, he gets ripped off on his rate. The guy who's he pays it after tax, whereas the big hedge fund or fund manager can come in and he doesn't pay any tax and he gets a lower rate, so he has a multiple times greater benefit. It's not a fair market. You have different people who've fundamentally different cost structures, and the tax system rewards those big funds to come in and take that stock away from the people. And I'm not like some sort of socialist, or I'm a capitalist through and through.
It's an observation, and I suppose it's one of the megatrends anyway that we're seeing, which is this change in society. It's going to be an increase in that wealth gap.
Yeah, but this is contrived. Well. This is not natural. This is not capitalism. This is what's the word you used to use, Mark, before? Was
corporatocracy.
Corporatocracy.
That's the trend. It's a form of fascism that the state and the large corporations are working hand in glove, and frequently, more often than not, that's against the interests of the small investor, the small business, the butcher, the baker, the candlestick maker, and so maybe we have to organize a boycott. That's what they did in the Land League.
Captain Boycott.
My great grandfather down in Mayo was part of that, organizing that boycott against the landlords. Fantastic. So but I don't know how effective that would be, because people are desperate for housing, and they need. But that's also leading to an inflation in the rents, because there's no free market in effect. So they can have the entire apartment complex and come in with a very high rent, but people are desperate to have to pay it. So you don't get, before you had a sort of more of a market, with different landlords at different rents, and whereas these guys, it becomes more, I think it's more risky, I think ultimately to the renter and to people, we have a homeless society, or a homeless crisis, should I say, out there in our society. So they're very real risks to when governments work hand in glove with corporations, and in effect, the corporations run the show. Governments, particularly small governments like Ireland, they are just not that powerful in the grand scheme of things anymore. It's funny. We're talking about the teams. The one thing we used to always talk about was this book here, Steve, is the road to serfdom. And I think that is one of the teams, that it's the individual, the small business is more and more at risk, and Hayek basically talked about the collectivist idea of empowering government with increasing economic control would inevitably lead not to a utopia, but to fascism. And I think, unfortunately, we are seeing a degree of that, and the lockdowns, or the pandemic lockdowns, have exacerbated that trend that was there.
Yeah, I mean, but when historically, I think it was it Bretton Woods? Yeah, Bretton Woods. They didn't have any bankers there at Bretton Woods, because they knew by having them there, they would corrupt the process, and you would bring in that corporatism. I think it was Mac Williams. He's a famous Irish economist, and he has a podcast, and he was saying this the other day. You should definitely check it out. Anyway, it's an interesting podcast, very, very thought provoking. But he's talking about it that it was only since the mid 90s when they let the Wall Street bankers into the White House that you began to see this incredible amount of financialization coming in, and development of hedge funds and this corporatocracy, I think, would started really then, or at least it was always there, but it really took off. And governments are very much held captive by lobbyists, and in other countries, and maybe not so much in Ireland, but you have a huge amount of money flows into the policy decision makers, and the constructs around that. So, but
into the media as well.
Yeah, and the media as well. Exactly. Yeah.
Well, gents, I think that's possibly a good spot to wrap this up. We've gone through all of the asset classes. We've looked at cash. We've looked at bonds. We've looked at cryptocurrencies. We've looked at stocks. We've looked at properties, and we've talked about precious metals as well. I suppose before we talk about the revolution, really what people need is to build awareness. This is about awareness and education. We've talked about a lot of topics and touched on a lot of themes here that are important to everybody, whether you have disposable income to invest or not. These are the themes that are going to affect you and affect your bottom line and affect your wallet over the years to come. So awareness is key. So if you've gotten something out of this podcast, we'd really like you to like it, but to share it with people that you think need to understand these things or start to understand these things, because it's only through awareness that people are actually going to be able to take action going forward and protect themselves. And on that note, I would like to thank Stephen Flood, CEO of GoldCore, Mark O'Byrne from Health Wealth Gold. Thank you very much, gentlemen, for being on this podcast. What we'll do is we'll have a follow-up episode to this where we've talked about the big themes here and the various different asset classes, but we might look at next how we might actually structure that portfolio that'll protect us for what is to come. So with that, I'm Dave Russell. This has been the Goldnomics podcast. Like and share this video. Comment down below if you've enjoyed it. And we shall see you again next time. Thanks for watching. If you found the information in this episode useful, please like and share it with others you think need to hear it. And you can also comment on this video and let us know what you think should be in your portfolio to weather the next decade. And if you're interested in learning more about how gold and silver can help protect your portfolio, visit goldcore.com. And you can watch all the videos that we referred to in this episode on our YouTube channel, GoldCore TV, or you can start with these videos here. And remember, if you want to see more interviews with industry experts and thought leaders in financial markets and be notified each time we upload more new content, subscribe to GoldCore TV and hit the notification bell now.